Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
Good to be back.
Today, we're jumping into JPMorgan Chase's first quarter results for 2025. We've looked through the earnings call transcript from April 11th.
Right. The goal is really to pull out the key takeaways, see how they performed, and, get their sense of the economy right now.
Okay, so starting at the top line, Q1 looked pretty decent.
Yeah, quite strong, actually. Net income hit $14.6 billion. That's $5.07 per share.
And revenue.
Revenue was $46 billion. They also reported a 21% return on tangible common equity, ROTC.
Okay. And wasn't there a sort of one-off item in there related to First Republic?
Yes, that's right. A gain of $588 million. Important to keep that in mind when you look at the overall numbers.
Definitely. So stripping that out, how did revenue compare year over year?
Well, total revenue was up 8% compared to Q1 last year.
Uh-huh.
But it gets interesting when you break it down. So net interest income, or NII, if you exclude their markets business, was actually down 2%.
Down. What drove that? Lower rates.
Primarily, yeah, lower rates and some margin pressure, especially on the consumer side.
But overall revenue was still up 8%, so something offset that NII dip.
Exactly. Higher revolving balances on credit cards, more securities activity, and also higher wholesale deposit levels helped make up for it.
Got it. And what about the other side, non-interest revenue?
That was strong. NIR, again excluding markets, was up 20%, or 14% if you take out that First Republic gain we mentioned.
And what fueled that jump?
Mostly higher asset management fees. They had fewer losses on their investment securities portfolio, and investment banking fees were higher too.
Right. You mentioned markets earlier. How did that division do?
It really took off. Markets revenue was up 21%. They actually had a record quarter in equities trading.
So volatility can be good for that business then.
It often can be, yeah. When things are moving, their trading desks tend to do well.
Okay, so strong revenue. What about the expense side of the equation?
Expenses were also up 4%, hitting $23.6 billion.
What were the main drivers there?
Mostly compensation, hiring in areas like trading and tech. Also higher brokerage and distribution fees, plus more spending on marketing and legal.
Okay. Anything else on the expense or sort of unusual items front?
Well, there was that FDIC special assessment. This quarter, they actually released about $323 million they'd previously accrued.
Ah, so that helped the bottom line compared to previous quarters where they were building that up.
Exactly. It was a positive swing this time around.
Now, let's talk about credit. Always a key area. What were the credit costs?
Total credit costs came in at $3.3 billion. That breaks down into $2.3 billion in actual net charge-offs loans they don't expect to get back.
Okay.
And importantly, a net reserve build of $973 million. They added almost $1 billion to their loan loss reserve.
A reserve build, that usually signals some caution about the future, right?
Absolutely. It gives you a window into their thinking. Their total allowance for credit losses is now $27.6 billion.
And did they say why they built reserves? Is current performance deteriorating?
Not exactly. They said their base case economic outlook was still pretty benign at the end of Q1. But, and this is key, they increased the weighting they're putting on downside economic scenarios in their models.
Okay, so they're hedging their bets more. What does that mean in practical terms?
Well, one concrete result is the weighted average unemployment rate embedded in their allowance. It went up from 5.5% last quarter to 5.8% now.
Doesn't sound huge, but directionally significant, I guess.
It signals a definite uptick in caution, yes. And it wasn't just consumers. They added $441 million for consumer reserves and $549 million for wholesale.
And the reasons. Macro outlook and specific wholesale credit worries.
That's what they cited. Changes in the macro picture and, yes, some specific concerns about certain wholesale exposures. But they stressed it wasn't really driven by major problems today, more about preparing for potential future issues.
Right, okay. Shifting gears a bit, capital and shareholder returns. How's their capital position?
Their CET1 ratio, the main capital measure, ended at 15.4%. It's down slightly, about 30 basis points.
And returns to shareholders. Buybacks, dividends.
Pretty significant. They returned $11 billion in total, $7.1 billion through net share buybacks, and they also increased the dividend to $1.40 per share.
And I saw their risk-weighted assets, RWA, ticked up.
Yeah, mainly driven by business growth, particularly in that strong markets division. More trading activity means higher RWA.
Okay, that's a good picture of the overall company. Let's maybe dig into the specific business segments now, starting with consumer and community banking, CCB.
Sure. CCB had a net income of $4.4 billion. Revenue was $18.3 billion, up 4% year on year.
Yeah, they said things like spending, cash buffers, debt service ratios, credit usage, all generally in line with their expectations.
Okay, so within CCB, how did banking and wealth management do?
Revenue there was actually down 1%. Lower deposit NII was the main drag.
Ah, that pressure we talked about earlier. Right. But it was mostly offset by growth in wealth management. Average deposits were down a bit, but client investment assets were up 7%, helped by market performance and flows into managed products.
What about home lending? Still slow.
Revenue up 2%, and originations jumped 42%. But, that's off a pretty small base. The housing market overall is still just okay.
And card services and auto. That often seems to be a growth engine.
It was this quarter. Revenue up 12%, driven by part NII, those revolving balances again, and also auto lease income. Card balances outstanding were up 10%, new accounts helping there, and auto originations rose 20%.
But that growth comes with credit costs, presumably.
It does. Card and auto credit costs were $2.6 billion, and that included a net reserve build of $475 million, mostly related to the card portfolio.
Okay. Let's pivot to the Commercial Investment Bank, CIB. How did that segment perform?
Very strong quarter for CIB2. Net income was $6.9 billion, revenue $19.7 billion, that's up 12%.
Investment banking fees were a highlight, weren't they?
Yeah, up 12%. They actually regained the #1 global ranking, they said, with about a 9% market share. Advisory fees up 16% on completed M&A deals.
And underwriting.
Underwriting fees also up 16%, mainly driven by refinancing activity, particularly in leveraged finance. Equity underwriting, though, was down 9%. IPO market still challenging.
But despite the strong Q1, they sounded pretty cautious about the IB outlook.
Very cautious. Said while client engagement is high, actually closing deals really depends on getting more clarity on the economy and geopolitics. A lot of uncertainty still.
Right. What else stood out in CIB? Payments? Markets?
Payments revenue was up 3%, excluding some equity investments, helped by higher client balances and fee growth, but offset partly by that deposit margin pressure again.
And markets we already touched on, really strong.
Yeah, up 21% overall. Record equities, fixed income up 8%. Securities services revenue also grew up 7%.
Expenses were up in CIB.
Up 13%, yeah. Similar drivers. Compensation, legal, brokerage costs. Average loans were down slightly, but average client deposits were up a healthy 11%.
And credit costs in CIB.
$705 million. And again, that was largely driven by adding to reserves, reflecting that cautious outlook.
Got it. How about asset and wealth management, AWM?
Another solid segment. Net income of $1.6 billion. Impressive pre-tax margin of 35%.
Wow. And revenue drivers.
Revenue up 12% to $5.7 billion. Driven by management fees, helped by strong inflows and higher market levels, plus brokerage activity and higher deposit balances.
Strong inflows, you said.
Very strong. $54 billion in long-term net inflows, mostly equity and fixed income, plus another $36 billion into liquidity products.
And overall assets.
Assets under management hit $4.1 trillion, and total client assets reached $6 trillion, both up about 15% year over year. Really significant scale there.
And briefly, the corporate segment. Anything major there besides the First Republic item?
Net income was $1.7 billion, revenue slightly up overall. NII was down, offset by NIR gains, which included that First Republic item. Expenses were down quite a bit, mainly because of that swing in the FDIC assessment accrual we discussed earlier.
Okay, so across the board, seems like a good quarter operationally, but with this recurring theme of caution.
Exactly. And that brings us squarely to their economic outlook and the level of uncertainty they kept highlighting. It really was a major focus of the call.
They used the phrase unusual uncertainty, didn't they?
Repeatedly. While their main forecast, their sort of central case, was still relatively okay avoiding recession, they made a point of saying they deliberately increased the probability weighting on negative scenarios.
You saw that in the reserve build, yeah.
It's a clear signal. They're definitely more concerned about potential headwinds than perhaps they were a quarter ago.
Did they give any examples of what they're seeing on the ground, consumer or corporate behavior?
Yeah, a couple of interesting points. On the consumer side, they thought they might be seeing some spending pulled forward. Maybe people buying ahead of potential price hikes from tariffs.
Interesting. Pre-buying.
Potentially. And on the corporate side, more of a wait-and-see attitude. Focus shifting to short-term things like supply chain optimization, less on big long-term plans. They noted smaller clients might be finding it tougher.
And didn't their own economists put pretty high odds on a recession?
They did mention their internal estimate is roughly 50-50 for a recession. So yeah, significant concern there. And the leadership expects a lot of companies might start guiding down their earnings because of the murky outlook.
But they did sound confident about the banking system itself.
Yes, they frame the banking system as likely being a source of strength, financially robust enough to support the economy. But they were careful to distinguish financial strengths from, banks' stock performance, which often struggles in downturns.
Right, okay. Let's talk NII guidance, net interest income. That's always a big focus. Did they change their outlook?
Okay, so for NII excluding markets, they actually kept the forecast roughly stable at around $90 billion for the full year.
Despite the increased uncertainty.
Right, but the firm-wide NII guidance went up to about $94.5 billion. The difference is they now expect markets NII to be higher, though they think that'll be offset elsewhere, likely in non-interest revenue from markets.
So, focusing on the NII ex markets piece staying flat, what are the moving parts there? Lower rates are a headwind, you'd think.
They are. The market expectation for Fed cuts, they mentioned maybe 3 cuts priced in, that's a negative. But it's being offset by a few things.
Like what?
Higher wholesale deposit balances than expected, better deposit pricing or betas on CDs, and wholesale deposits, meaning they aren't having to raise rates quite as much as feared. And they also removed a placeholder they had in for the potential hit from that card late fee rule change.
Okay. So a few positives balancing out the rate headwind for now.
Seems to be the case, netting out to a stable outlook for that core NII ex markets number.
Okay. And circling back quickly to credit quality and reserves, they built reserves out of caution, but are they seeing actual problems now?
They emphasize they haven't seen meaningful deterioration in actual credit performance yet.
But they still expect card losses to rise. What was their forecast for card charge-offs?
They kept the full-year card net charge-off rate forecast at around 3.6%. But both Diamond and Barnum were quick to add that's a short-term forecast, and the range of outcomes could be pretty wide depending on the economy.
Right. Not set in stone.
Definitely not. They also said performance for the next couple of quarters is sort of baked in already, just given how delinquencies progress to charge-offs. Big variable they're watching, especially for consumer credit, is unemployment.
Makes sense. If people have jobs, they tend to pay their bills.
That's the general idea, yes.
So with this uncertain outlook, what's their plan for capital deployment? Are they pulling back?
The message was pretty clear. They feel prepared for anything, and they actually have excess capital right now.
So no big changes to investment plans.
They said they'll keep investing in branches, tech, AI, regardless of the near-term environment. But they also explicitly stated a preference for holding that excess capital, given the current turbulence. Financial strength allows them to support clients through thick and thin, essentially.
Right. Flexibility is key. Another big topic they hit on was regulation. Seems like they have some strong views there.
They certainly do. They called for reforms across a whole suite of regulations: SLR, G-SIFI surcharge, CCR stress tests, Basel III endgame, LCR, basically the whole post-crisis framework.
And their argument is that the current rules are, what, too restrictive?
Their point seems to be that the rules, as currently designed, can sometimes hinder banks' ability to intermediate markets effectively, especially during stress. They think reforms could improve market stability.
So let banks be more active market makers, potentially reducing the need for Fed intervention.
That seems to be the core of their argument, yes. That it's not just about the banks, but about better market functioning overall.
Are they optimistic about reforms happening?
They mentioned having constructive dialogue with the administration, saying there seems to be some interest in pro-growth policies and potentially easing bank participation, a recognition that maybe some rules have flaws.
And internally, they're also trying to streamline, cut red tape.
Yeah, they mentioned ongoing efforts to improve efficiency, reduce bureaucracy. They also voiced concerns about the sheer cost of some of these regulations, like resolution planning and CCR.
Okay. Shifting to market dynamics, they obviously benefited from volatility in Q1 trading.
Yes, recent volatility was generally good for performance, but they made a distinction. Sometimes you get gappy volatility with low volume, which can be negative. But generally, more movement means wider spreads, more volume, better trading revenue.
Any specific market concerns they flagged?
They did mention Treasury market functioning as something to watch, especially with rates having moved higher. They floated the possibility of the Fed needing to step in eventually if problems arise there.
Though they said it's not like a typical risk-off flight to Treasuries right now.
Right. Different dynamics at play currently.
And being a huge global bank, any comments on international issues? Trade tensions.
They acknowledged that as a big U.S. international company, they can be in the crosshairs during trade disputes. Some clients or countries might view American banks differently in the current environment, something they need to navigate.
Makes sense. Finally, anything on cost management going forward? If the economy does slow down, can they adjust expenses?
They pointed out some costs are variable, tied to volume or revenue, so those would adjust automatically. They might also reassess the business case for certain investments if things really sour.
But core strategic investments continue.
That was the message. Committed to the long-term stuff, but always looking to streamline, cut bureaucracy, and eliminate unnecessary costs internally as well.
Okay, so wrapping it all up then. Strong Q1 numbers, but clearly overshadowed by this theme of increasing economic uncertainty and caution.
That's the main takeaway, I think. Good performance, record equities trading, solid results across most divisions. But paired with that reserve build, the cautious commentary, the focus on downside risks, potential tariff impacts, it's a balancing act.
And the regulatory discussion remains a key focus for them too.
Definitely. They see potential reforms as crucial not just for them, but for broader market stability.
All right, well, that gives us a good snapshot of JP Morgan's quarter and their current perspective. As always, this is just our take based on the call.
Indeed. Listeners wanting a deeper dive might look at detailed analyst reports or financial news coverage for more perspectives.
And of course, how this economic uncertainty plays out and impacts banks like JP Morgan will be something we continue to track very closely.
Absolutely. The situation is still evolving.
Thank you so much for tuning into the quarterly call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.